I have a major warning for all of the SoFi investors, although we decided to invest into this company. If you want to keep your money and not to lose half of your portfolio, please listen to the information in this video. I promise it will be very helpful, especially in the long run. Hey there and welcome to the Market Monkeys channel. It's Julia here, and as I already mentioned, we decided to invest in SoFi, but it's not as straightforward as you might think. To understand our point of view, let me explain our key points in valuing this company and the risks that we will be paying attention to in the long run. First of all, the SoFi is a very nice company that is growing and showing nice results. They have prime customers, a growing ecosystem of products, and strong marketing efforts. On the financial side, they have growing revenues, high gross margins, and they beat analyst expectations for God only knows how many quarters in a row. From the other point of view, they present themselves as a fintech company, although most of their profits are coming from the banking services. This is actually a very important point, and we will be talking a lot about this today. And after all, they're a meme stock with everything that comes out of it. Huge volatility, irrational and violent stock swings, over positivity or negativity without many reasons, or in other words, stock is heavily dependent on the moods of the investors. To figure all of this out, let me tell you a few words why we decided to invest in SoFi. The first reason, of course, is their growing financials. Rapid revenue growth of more than 200% from the first quarter of 2021 until today. High gross margins of 80% when the sector's average is about 60%. The company is profitable 3 quarters in a row and expected to bring even more profits as a result of growing number of members this quarter. They had 643,000 new customers, or members as they're calling it, in second quarter 2024, bringing total to nearly 8.8 million members, or plus 41% year-over-year growth in members. They're beating analyst expectations consistently. Out of 12 last quarters, they missed only once, and even this was due to consolidation of Galileo and Technisys. If you find this information helpful, you can help us as well by pressing a like button and subscribing to our channel. Another reason why we decided to invest is the fact that fintech as a sector has never rallied yet. Here you can see a performance of fintech ETFs. Even from a graph we can see that there was some growth, but not by much, and this growth is due to the overall market being very high back then. Now let's take a look at AI ETF as an example for the fast growing sector. If we would get in before this rally, we would be very rich by now. So the same goes to fintech and to SoFi. Here are two scenarios. First one, whether it's not the time yet, and when it will come, being invested in the fintech long before will play very great for us. Or another possibility, it won't come and then we'll have to hope only for stable business and great results, what SoFi is successfully delivering for now. But I have another question regarding this. SoFi is playing in two different businesses, fintech and banking. And if the banking business will win, we might get into the big trouble, because PE ratios of banking companies are very different from PE ratios of tech companies. And to make this uncertainty of mine more understandable and supported by numbers, let's see where the money is coming from. On this screenshot from their latest earnings results, we can see the breakdown of their revenues by segments. The revenue from lending, I assume that this is loans that they're lending to their customers, is about $340 million, while revenue from technology is about 95 million. So it's approximately 3.5 times less than the revenue from lending. Also, they had about $176 million in revenue from financial services. This shows that the fintech portion of revenue is smallest of all. Revenue from lending plus revenue from financial services take more than 80% of total revenue, and it gives us less than 20% revenues from tech. And before you say that the tech sector is growing, it's actually growing slowest of them all. In 2 years, starting June 2022, lending grew 32.3%, financial services grew almost 500%, and tech grew less than 15%. So the question remains open. Why do they call themselves a fintech company if they have only a small tech division in their company that is not growing by much? Most of the regular banks already have apps and provide digital services, so it's also not a very good answer. Anyway, this piece of information makes me cautious. If you know the answer, please let me know in the comments. Another major point, I could even say one of the most substantial points for me, is the fact that analysts and more importantly regular investors see SoFi in a very positive light. And for me, it's a strong indicator that this is safe to buy a stock. Let me explain. In general, I believe in behavioral finance, and I believe that sometimes the moods of investors can impact the stocks more than any other political or economical factors. For example, what's happening right now with Palantir is much easier to explain by behavioral finance than any other valuating technique or financial metric. Their PE ratio is through the roof, being more than 200, and by many analyses, including our own by the way, the stock is supposed to be in the range between 25 to 32 if we are being very optimistic. People simply believe in this company, people continuing to buy this stock, and because of this crazy positivity, no one dares to begin a major sell-off or to short the stocks of this company, although it could be actually a good idea with the current valuation. Disclaimer, I'm holding Palantir myself, I am not selling for now, I already sold part not because of the pricing, but my own reasons. I have a video about this on our channel, so you can go and check it out later. So let's come back to our video. This is also applicable to SoFi. It is really difficult to find any criticism about this company, or for that matter, even information about the risks of investing in SoFi throughout the internet. And it proves my point that people and analysts are simply loving this stock. But it gives me the space to say what I am cautious about and what I will look out for in the future. By the way, if you choose to believe that there is such thing as stocks without the risk, you are more than welcome to turn off this video right now. But if you want to see SoFi from the realistic perspective, you must listen to the information that I am about to say, because it involves some of the major risks of investing in this company. SoFi's target market consists of high-income individuals with an average income of $160,000 and high FICO scores averaging 740 plus. So these are prime customers, and it's a major advantage of the company. But something doesn't add up. The average customer has $2,621 deposit in SoFi. It means that while customers of SoFi have pretty big income, $160,000, there is only $2,621 on average on each account. Does this mean that people are preferring to use SoFi as an additional bank but hold most of their assets in their regular banks? I'm not sure if the answer to this question is yes, and if so, why do people not choose to transfer all of their money to SoFi? But I only know that to understand whether or not SoFi can compete and beat their old rivals, we need to pay attention to this metric in the future. As for my next point, take a look at this graph that I've built. SoFi's average revenue per user was more than $450 in 2019, and it dropped to a little more than $200 in 2023. We can explain it by the fact that in 2019 SoFi had around 1 million users. After this they had rapid growth, and by the end of 2023 SoFi reported having over 7.5 million members. So they grew 7.5 times in members but dropped approximately 55% in average revenue per user. I assume that their ARPU, average revenue per user, will continue to drop even more as they bring more and more customers, but even if we assume that it will stay as it is, it's still much lower than for regular banks. Let's take a look at JP Morgan presentation. Unfortunately, I did not find the same breakdown for 2023, so we will take a look at 2022 instead. Here we can see that JP Morgan had 79 plus 5.7. It gives us 84.7 million customers in consumers banking. In the same presentation, we can see that revenue was 54.8 billion, and what is interesting, average deposits were $1.163 trillion. Let's calculate average revenue per customer by dividing $54.8 billion by 84.7 million customers, and we will get $646.99, which is significantly more than $200 for SoFi. So basically, a regular bank that doesn't present itself as a bank for prime customers earns 3 times more from each customer than SoFi does. Another metric that I will follow for SoFi in the next few quarters is their average deposit, that is also lower than for regular banks. For example, for JP Morgan, it's $1.163 trillion divided by 84.7 million customers, and it gives us $13,730 per customer. So basically, an average on each account, people have around $14,000 in regular banks, and for SoFi is less than 3,000. So after analyzing all of these points, we decided to invest in SoFi, but we won't be buying stocks of the company. We will buy call options instead. Few words about call options. Think of a call option like a ticket that lets you buy shares at the set price, called strike price, before a specific date or expiration date. You pay a small fee, the premium, for this ticket. If the stock price goes up above the strike price, you can still buy it at a lower price and sell immediately, gaining profits. So I decided to buy options with the expiration in April 2025 with the strike price of $12 and see what will happen out of it. As a result of all of the uncertainties that I'm worried about, I decided that I will buy not much, up to 5 contracts, because if they won't play out, I will be okay to lose all of the money that I invested, all of the premium that I paid, or most of it for that matter. Let's take a concrete example. SoFi is a pretty volatile company for which stock jumps of 30-40% is not uncommon. If we assume that the stock will jump, for example, to $15 in this time frame, if we would buy the stocks for $1,000 right now, assuming that the stock price is $10, for example, we would get approximately $500 in profit, or 50%. Now let's check option prices for April 2025. We can buy options with a strike of $12, let's say for a premium of $103. In a contract there are 100 options and you cannot buy a fraction of a contract. So let's say we decided to buy 10 contracts or 1000 options. It will cost us around $1,030 and we decide to exercise them if the stock will hit $15. The same $15 for which we sold the stocks that we bought in the first scenario. Now for each option the profit we will get is 15, the price at which we will exercise, minus 12, the strike price, minus 1.03, our premium, and we get $1.97 per option. We bought 1000 options, so the profit we will get will be 197 times 1000 and we get to almost $2,000. Or in other words, we will take the profits of little less than 200%. Why go for options at all? I think the upside is very clear. We get bigger profits for very small investments. You can basically control more shares with less cash and your risks is limited to a premium that you paid. But there is a catch: time. If the stock doesn't rise before your options expire, you lose all of your money or some of it, because the closer it gets to the expiration date, the less valuable your option becomes. For example, if we would decide to buy options not for April 2025, but for the middle of 2026, for example, we would pay significantly more for each option. Right now it's about $267, so it's basically more than 2.5 times more expensive than the ones that we bought, but we could also lower our risks by this. If you have some questions about SoFi or about options, feel free to ask them in the comments. But if you never used options before, I suggest being careful and maybe even seek a financial advice from a professional. Thanks for being with me. Hopefully this information was valuable for you, and if so, press a like button and subscribe to our channel. I'd really appreciate your comments. See you on our channel in our next videos. Happy investing!